Hey, welcome back to the Brent Bruce Daily for February the 15th, 2023. It is now 2:41 p.m. Central Time, and we have a lot of information to go over here. A few things have happened in the last couple of days. And as you know, yesterday the Consumer Price Index report came out. However, I was out of the office all day and unable to give you an update as those numbers came out. Unfortunately, inflation did show to be at a higher reading that we had expected and than we had hoped. So what we hope for, what we're thinking is going to happen, and then what the markets were thinking was going to happen, it actually came out higher and hotter than both of those. So unfortunately, that is not good for our home loan projections or our current home loan interest rates. So we're going to take a look at that report. Also, a second report that came out today, which we have to look into just a little bit, and a third item of importance to know about, which we're going to touch on before we get into our charts and also our interest rates for the day. So let's jump right in. So first of all, the Consumer Price Index is something that we pay close attention to. And if you go in here and you type in CPI or Consumer Price Index to just a Google search, this is going to pull up. This report is put out by the Bureau of Labor Statistics. This breaks down not just the basic number, but really how they come up with these numbers. So you see here, it says that the Consumer Price Index for all urban consumers rose 0.5% in January. Now, this is what is considered the headline number. This is all items that are included in the Consumer Price Index. It talks about down here, it says over the last 12 months, all items of this index increased 6.4%. Now that means that those items in the Consumer Price Index, so that is the bucket of goods that they're monitoring, measuring, went up 6.4% in cost over the last 12 months. Okay, so that's important to understand what you're looking at. Down here, it says all items less food and energy rose 0.4% in January. And later on, it goes to tell us that it rose 5.6% over the last 12 months. Now, so this is the same basket of goods, but minus food and energy. And why did they do that? Because food and energy is so volatile that they want to kind of see what these other items look like. However, it does include housing. So the core reading does include housing, which is something that we have to pay attention to a little bit further down. So if you go further down here, you'll see some more monthly breakdowns of how they break up the Consumer Price Index. You'll see right here, all items less food and energy, which again is that core reading. Then down in the report, it talks about some specific categories. It talks about food, gets into that, energy gets into that, all items less food and energy, which again is that core reading. What we want to pay attention to is right here. The index for all items less food and energy, so that, again, this is the core reading, was at 5.6% over the last 12 months. However, pay attention to this line here. The shelter index increased 7.9% over the last year, accounting for nearly 60% of the total increase of all items less food and energy. So this is what you have to do, is you have to think about what that is telling you. So the housing component of the core reading of the Consumer Price Index accounted for 60% of the increase over the last 12 months. That tells you that all of the other items are going up by a very small amount for the housing factor to be that effective and to be making go up by that much. Now, it makes sense, right? Mortgages have gone up, house prices have gone up, rents have gone up dramatically. Some of these areas 20% year over year on those specific items. However, this is how we can start looking into our projections. What do you think? You have to ask yourself what you think. From month to month right now, are home payments getting more expensive, or are they about the same? I'm not saying have they not gone up from last year, but I'm saying from December to January, are home prices increasing? Or are they slowly going down? Are interest rates going up? Or really from December or November, have they come down? Are rents still increasing, or have they at least stabilized? And that's what I believe, is that if you look at housing on a month over month basis from like December and January, we're probably either decreasing slightly or at least stabilizing, because interest rate increases they were earlier in 2022. We're starting to see home loan interest rates either stabilize or even come down, which is something that we're going to actually experience in our reports in the coming months. So in the March and April and May timeframe, we're going to see that housing component get a little bit cheaper, going down a little bit and not increasing, at least not increasing as much, which is going to allow that core reading to come down substantially as all of the other factors are coming down as well. So you can see what I'm saying is that the housing component is what is really inflating more than all of the other items that are in this basket of goods that we're calling the consumer price index. And I hope that makes sense. That's where I'm projecting such big drops in the coming months. So let's take a look at the other item that I wanted to pay attention to, which is contrary to what we just talked about. So now here we get a report today that says retail sales jumped 3% in January, smashing expectations despite inflation increases. So what we basically need to understand here is that people are spending a ton of money, and where are they spending their money? It says food services, drinking places, motor vehicle parts and dealers, and furniture stores. Okay, so are these necessary items? Are food restaurants, drinking establishments, new cars and furniture items that we need no matter what happens to the economy? I'm going to say no. Okay, so these are items that when the economy gets tight are going to get cut back on very quickly. You'll pull back on going out to restaurants. You'll pull back on buying new cars, allowing those numbers to change dramatically as people begin to have to pull back and slow down. Why would they have to pull back and slow down? Because as you know, and we've talked about in many of the previous reports, we're seeing annual savings rates decline dramatically, and we're seeing the amount of consumer debt increase dramatically to the highest it's ever been in the history of the United States. This is not something that we want to see. People are going to have to slow down their spending because of the more expensive cost of money by the Federal Reserve increasing the federal funds rate. So these are the reasons that we're seeing clearer skies in the home loan interest rate world here in the future. Now, quickly, the last item that I wanted to mention is Lael Brainerd is one of the chairs of the Federal Reserve. Okay, one of the Federal Reserve, what is her title right here? Directors. So she has been moved over to a different position within the Biden administration, which is going to leave a vacancy on the voting panel of the Federal Reserve when they make changes to the federal funds rate. We have to pay attention to that because anytime that happens, we're concerned with who is going to replace her. We know who we're dealing with when we're dealing with Lael Brainerd. We don't know who is going to replace her. So that's something we have to pay attention to as well. So let's take a look and see where home loan interest rates are and our mortgage-backed securities are with all of this news that has come out. Now, at this moment, we are currently down 3 basis points on our mortgage-backed security, and we're up 5 basis points on the 10-year Treasury. Neither one of those are good things, but the fact that we're down 3 today is actually pretty impressive. We were quite a bit further down on the market today earlier, but we have been fighting back. Where are we at on the actual charts? I mean, you remember when we were talking about up here battling with the 200-day moving average. Well, that seems like a very long time ago as we've broken through 1, 2, 3, 4, 5, 6 floors of support, basically because of flat numbers and then this crazy employment number that came out, and then now having our CPI report coming up with inflation showing a little bit higher than we wanted it to. So here we are now using the Fibonacci level at 99.845 as our floor of support, but we are seeing a little bit of a rebound throughout the day today, hoping that begins to build some steam. What does that mean to our home loan interest rates? Seems like a lot of bad news. So where are we on our on our home loan interest rates today on our Brent Bruce Daily? So you know that we were talking about 5.875 with no points only 2 weeks ago. Then all of a sudden we were talking pretty consistently about 6.5%. Well, here we are, 6.49% with a little bit of a credit of $79 on our Brent Bruce Daily scenario. Not as bad as I would have expected, right? If you want to pay a point, you're at 6.125. To get to 5.99, you're paying 1.339 points. Still not too dramatic considering the news that we have been receiving. So let's take a look quickly here at our scenario, break down all the parameters of our Brent Bruce daily scenario. All right. So that's what's been going on over the past few days. A lot of big news. We are getting the producer price index tomorrow, which hopefully will continue to help us bounce off of that floor and begin to build some more momentum. And I believe it's February the 27th, if I remember correctly, January the 24th, that we're going to be getting our personal consumption expenditures report, which also is going to be interesting after the CPI came out with such a surprise. I will keep you posted. I'll let you know what was going on tomorrow. We'll talk to you again. Let me know your thoughts and make sure that you like, subscribe, and share. We'll talk to you then.